Hi guys, this is Devang Meshwari from equialpha.com. In our financial life, there are two ways to earn money. One is the active source of money in which you go to office daily, spend 10 hours sitting on a desk. And if you are in business, you probably spend more time, 15 hours, 20 hours of your day to earn some money. And the other way is very cool, in which you just give some time to your money and it grows by itself. One should have both sources of income as it just helps in financial independence. So in this video we'll talk about 4 passive income investment ideas that you should be investing right now. So keep watching the full video. The first one is index funds. Let us first understand what is index and then we'll look on to what are index funds. An index is made in India by national stock exchanges and Bombay stock exchanges. These are made for tracking purposes and are basically a portfolio of stocks that are made for particular purposes for achieving a particular objective of that index. For example, Nifty IT. Nifty IT is a portfolio of IT companies that represents the entire IT sector. So this has been made for the tracking purposes of entire IT sector movement. Another example for you is Nifty Dividend Opportunities 50. This is a group of 50 stocks which have the highest dividend yields. And also these indexes are made based on certain parameters like qualitative parameter, quantitative parameter, for example with regard to growth, with regard to quality, with regard to promoter holding and different parameters. Those parameters are already stated in the index statement. Also these indices are dynamic in nature, so you don't have to worry that who's looking onto the portfolio. The portfolio and the stocks are being continuously monitored by the exchanges itself and they rebalance that at particular regular intervals. Now there are around 50 indexes. How to invest in an index? Basically, you cannot directly invest in an index. For investing in an index, you need to actually invest in an index fund. An index fund is made by different financial institutions like SBI Mutual Fund, Kotak Mutual Fund, Edelweiss Mutual Fund, HDFC Mutual Fund, and all these asset management companies, mutual fund companies which you see around, they all have a financial product which is called as exchange traded fund. Exchange traded funds are super easy to invest. Also, it has a very low cost and you can simply invest in those exchange traded funds for some passive investments. You get an opportunity to invest in a strategic portfolio which is being already managed, looked after and rebalanced as per the objective stated. In India there are 50 plus indexes, different type of sectoral indices, different type of strategic indices. Now which one to invest? Don't worry, I know. You'll subscribe the channel and press the bell icon. Now which one to invest? The fund to invest into it has 30 stocks in the portfolio which are based on very good growth rates and which are very qualitative in nature. Also, this index has given 15% annum returns since 2005. 15% CAGR. Yeah, that's for true. And even after the crash today, it stands the same 15% CAGR. So you can understand that how good that index is. The name of that index is Nifty 200 Quality 30. This is the name of the index. Now, how can you invest into Nifty 200 Quality 30? This is basically a portfolio of 30 stocks chosen on basis of growth and qualitative characteristics. To get exposure towards that index, you need to invest in ETF which is called as SBI ETF Quality. SBI ETF QLTY. It is an ETF which is launched just 1.5 year back based on that index. Now don't get confused. One, there is an index. An index is just made for objective of tracking and giving some ideas for different investors. However, if you want to invest in that index, you can't directly invest into it. For that, those financial institutions have made financial product and one of that product is exchange traded fund. So when you buy an exchange traded fund, you are automatically getting exposure to all those companies which are in that particular index. I hope this is clear now. Okay, for getting exposure to this Nifty 200 Quality 30, you need to invest in SBI ETF Quality. There is no other ETF that gets exposure to this index, but this index performance has been very good. As I told you, it's around 15% per annum even after the crash. That's the compounded annual growth rate. And since this ETF has been launched by just 1.5 years back, this is highly underrated and people doesn't have any clue about it. When you're getting a particular portfolio of stocks that are performing very good, it creates a good opportunity for passive investment, right? The current price of this ETF is just 93 rupees, and how to invest into it? Don't worry, it's super easy to invest into an ETF. All you have to do is, just like you buy up any stock, you search in the watch list, right? Wherever your broking account is, you search upon. For example, SBI you search. If you want to buy HDFC Bank, you search HDFC Bank. Similarly, you just search SBI ETF quality and you will get the ETF there. Just like you buy up any stock by clicking on the buy button, just click buy, enter the quantity that you want to buy, magic. Now the second passive income investment idea. I know in this so uncertain time that there are a lot of bankruptcies, the economy is going through really hard times, there is a coronavirus shit going on, then after that India-China war, US-China war, and what else is not going right now, and you all might be looking for some low risk passive income investment idea. So this is for all those people who are looking for ultra safe passive income. The name is GILT funds. GILT funds are funds that basically invest into government bonds. See, government bonds carry fixed interest income and it also is very safe because it's been issued by Government of India. Now, if the Government of India defaults itself, then eventually everything will be defaulted, right? That's why it is very ultra safe and there are very less minute possibility that such thing might happen. Now, these GILT funds give you access to a lot of government bonds, and since these government bonds backed by government, it is very safe to invest into these GILT funds. However, I don't see many people investing into GILT funds. GILT funds can give you interest income more than fixed deposits. In today's scenario where the fixed deposits are not also secure, you only get few lakhs if the bank eventually wipes off, then such GILT funds give you a better opportunity and very competitive interest rates. Now, which GILT fund to invest out of so many GILT funds that are already present upon? Don't worry, I've done the work for you. The name is IDFC GSEC Invest. IDFC GSEC Invest is a fund that invests into different maturities of government bonds and 100% into government bonds. There is no other thing apart from government bond into it. So it's very safe to invest and it gives a very competitive earning. IDFC GSEC Invest started in 2008 and till now, since inception, this annual return is around 9%. So 8.5 to 9% is what you can currently expect out of that fund. It is very competitive to fixed deposits where you're getting fixed deposit interest on only 6%, 7%. And the best part is that you can redeem upon this GSEC by just a click, right? So it doesn't have any lock-in period like FDs. You have lock-in period. If you are maturing FD before, it has some fines, it has some rules with regard to it. But here you don't have any lock-in period. So that's the good part. So you get a backing of government that makes it very safe. You get a good competitive interest rates and that can earn you passive income. Now the third one. Now I know nobody likes lower return. People are ready to take high risk for high return. So this one is for super risk takers. And when I mean super risk takers, literally I mean super risk taker. And this option can give you 36%, up to 36% annual returns, fixed annual returns. Yeah, that's what I'm talking about. Now what is that? That is peer-to-peer lending. Now, peer-to-peer lending is a very new area. I know you would have not heard it before, and that's the purpose of taking that idea into this video. There are many people in India that want money, that want to borrow money. And banks, NBFCs are all lending institutions which give the person the required loan. So for example, if I want a loan, I'll go to bank. Then if the bank is not giving me the loan, I'll go to an NBFC. If the NBFC is not giving me a loan, what would I do? This is the third option. This is an option where a person gives loan to another person. In this peer-to-peer lending option, you are basically lending money to a particular other person. But understand that the other person might be in a desperate need of funds and the bank would have rejected his loan because of his credit history, that he might not be repaying the loans on time. Or the second case might be that the bank is taking too much time, that the person just lose up his patience and apply for higher interest rate loans. So the peer-to-peer lending interest rates are around from 12% to 36%. And these are usually those category of people who are not getting loan from anywhere. So now you can become a lender who will lend money to some other person who wants it. Now, how does this happen? This happens to various startups that have emerged in this area. So there are various startups like Fairsend, I2I Lending, Lendin, Rupee Circle. None of these websites are endorsements, but these websites give you a platform through which you can simply become a lender and earn fixed interest by lending money to the other person. These startups claim that they are doing a lot of technological algorithms like machine learning, artificial intelligence to check that whether the person is genuine, to check whether the person will return back the money. However, let me tell you this. In this P2P scenario, the default rates have been very high, ranging from 5% to 10%, and that's huge. And once the default is done, you don't have much option, because that person might be in some other state, that person might be in some other locality, though you know that where he is living, but it's very difficult to physically reach to him and collect money back. And due to those reasons, I don't recommend this option. But still, if you want to take that high risk, you can try out these different startup platforms. If you don't want to take that amount of risk, I have another option for you. See, I'm giving you so much options. The next option is investing into dividend stocks. Now, what are they? There are many blue chip companies in India that gives a lot of dividend to the shareholders. They have so much of cash within their balance sheet, and they literally don't know what to do with those amount of cash. So they just give out to shareholders, and it's really good that you earn some cash in form of dividends. How to see the dividend yield of a company? A dividend yield is just amount of dividend that the company gives divided by the market price. For example, if a company usually gives 2 rupees in dividend and the market price is 20 rupees, then the dividend yield comes to 10%, and a 10% dividend yield is very good. However, let me tell you a problem with dividend investing, because you need to know this before investing into dividend stocks. The problem is that if the company is very volatile in nature, then your dividend earning might get set off by the capital loss, right? For example, if you invested at 20 rupees for a 10% dividend yield, however, the price crashed from 20 rupees to 15 rupees. So now you are at a loss, right? That's why it is very important that you invest in those companies for dividend. Those are very less volatile and that have a good consistency of dividend payment. And always invest in blue chip companies when you're looking for dividend stocks, because these are very mature, stable companies. One example is towards IT companies. They give a lot of dividends, right? So you can simply invest into it. They are so mature, so big, and they're comparatively less risky. So that's one option. And how to look onto dividend yield stocks, high dividend yield stocks? You can go onto this website screener.in, and you can run up a screen by putting a query that dividend yield should be greater than 5% or 6%. So you can take help of that website in finding dividend yield. And another way to find out high dividend companies is to look onto the index which I told you before. So I told you about index, which is Nifty Dividend Opportunities 50. So you can go onto that index and see the constituents of that index, that what are the companies in that index, because that index also have companies which pay a lot of dividend, that have high dividend yields. So you can use this two way to see upon which company is giving high yield and invest onto dividend stocks. So that was all about passive income investment ideas, in which I've shared you 4 options which are having different set of risk categories. Right. So the first one, index fund, which we saw, SBI ETF quality, that is of medium risk. The second one which I shared was GILT funds. So GILT funds are ultra safe investment, which gives you more than FD, which gives you more than savings account, and also it has the flexibility that you can withdraw at any moment HPT you want. Right. Third, I gave you a super high risk, that's peer-to-peer lending, in which you just become a lender to a particular person and you give a loan at a particular fixed rate of interest. And the fourth and the last one was dividend stocks, in which you can invest into high dividend yield companies. This is also come into medium risk category. So that's all for the investment ideas. Do remember to share this video so that that insights can help some person in making some passive investment income. So see you all guys. Don't forget to subscribe and press the bell icon. See Devang Maheshwari signing off.